Bismillahirrahmanirrahim. Welcome to my business educational platform. Remember in last lecture we discussed the topics from the risk reduce, portfolio return, portfolio risk, and the coefficient of correlation and risk diversification. So these were the topics that were discussed in our last lecture, in which we discussed some of the portfolio. So remember, do not put all your eggs into one basket. If one will be fallen, then ultimately all the eggs will be broken. So same is the case. Do not put all your investment into the single stock. So you have to create the portfolio in order to diversify the risk. So combining securities that are not perfectly positively correlated reduces risk. So correlation shows if you are comparing two stocks and you find the correlation, if one stock is high risky, certainly you will not invest in that stock. So in today's lecture we will cover the total risk, that is sum of systematic risk, that is also known as a standalone risk, and unsystematic risk, that is known as a portfolio risk. So systematic risk, also known as the market risk, is the variability of return on stocks or portfolio associated with changes in return on the market as a whole, also called market risk. Then we have the unsystematic risk. It is the variability of return on stocks or portfolio not explained by general market movements. It is avoidable through diversification, also called diversifiable risk. So here same example also applies here. If you will diversify your stocks investments, then certainly you will diversify risk. If you will put all the eggs into one basket, so that will be high risky. If one will be broken, certainly your all investment will be wasted. So I hope you understood the idea behind the systematic risk, that is standalone risk or the market risk, and the unsystematic risk, that is portfolio risk or the diversifiable risk. So here is the graphical representation of risk. Systematic risk, you see, it is the constant. It is the market risk. We cannot avoid from that. So systematic risk is due to various factors such as changes in nation's economy, inflation, unemployment risk, tax reform by the Congress, or change in the world situation. Then we have the unsystematic risk. You see, if you will diversify your portfolio, you are diversifying your risk. On the vertical axis we have the portfolio return. On the horizontal axis we have the number of securities in the portfolio. So what is beta? Beta is a measure of risk, an index of systematic risk or the market risk. It measures the sensitivity of stocks return to changes in returns on market portfolio. Beta measures the tendency of stock to move up and down with changes in the market. So if beta will be 1, it shows security is risky as the entire market. So 1 is the basic benchmark for the market. If it will be the 1, it will be aligned with the market, or it will be same as the market risk. If it will be 0.5, it shows that it is half risky as average security. If it is 2, it shows that its security is twice as risky as an average security. So I hope you understood the idea behind the market beta. It is the measure of risk. If it will be 1, it will be associated with the market. If it will be half, it will be half an average security. If it will be 2, it will be twice the security of an average market. So here is the graphical representation of beta. If it is greater than 1, it is aggressive or it is high risky. If it is 1, it is almost okay. It is okay with the market risk. If it is less than 1, it is very defensive. So on vertical axis we have return on a stock. On horizontal axis we have return on market portfolio. So how we can find out the beta portfolio. What represent the beta of portfolio? It is the same. It is the risk of portfolio. It may have the market risk of overall risk of portfolio. The average beta of security in a market is the range of 0.15, 0.5 to 1.5. The portfolio consists of low beta securities itself will have a lower portfolio beta. The beta portfolio is weighted average of beta at its individual securities. So certainly you will have the beta of 1 and you will assign the weightage to it. Suppose you have 3 stocks, then you will diversify based upon 3 stocks. If you have 5 stocks, then you will diversify your risk and give weightage as per the 5 stocks. So if you have 100, you will certainly provide the weightage as per the 100% criteria. Suppose you are getting 4 stocks, then you will certainly divide it into 4 stocks. If you are getting 3 stocks, certainly you will diversify it within 32%. So here is an example of beta of portfolio, how to calculate the beta of portfolio. Suppose you decided to invest in the 3 stocks in amount of 1 lakh. The stock has the following values of beta. So the beta is given and the valuation of investment is also given. We are assigning the weightage to it. So what will be the weightage to it? It will be the 33%. How we have calculated it? We have calculated it with multiplying the 3 stocks with the overall investments, and here we have the given beta. Simply what we will do, we will W1 beta 1, W2 beta 2, W3 beta 3, and sum of all we will come to an end the beta of portfolio. So then we have the capital asset pricing model. Capital asset pricing model shows the relationship between risk and the return. In this model, security is expected to require return as risk-free rate plus risk premium based on the systematic risk of the security. So what is the systematic risk? It is the market risk like changes in inflation, economy, or the tax rates. It is also known as the standalone risk or the market risk. The model was evaluated by Hari, Markowitz, and William Sharp. So here are certain assumptions regarding the capital asset pricing model, like it considers all the markets are efficient. That is not the case with the real world, as there is not instability in the market and there exist no efficient markets. Then we have the homogeneous investor expectations over a given period. Like all the investors, homogeneous means same, all the investors expectations will be same over a given period. Then risk-free asset return is certain, RF is certain. Then we have the market portfolio contains only systematic risk. It does not contain the diversifiable or the portfolio risk. So here is the formula behind the systematic security market range, where RJ is required return on the stock, RF represent the risk-free rate, beta I represent the beta of the market, RM represent the market risk, and RF represent the risk-free rate. So RJ represent the required return on the J stock, RF the risk-free rate on return, beta is the beta of J that may have the systematic risk, RM is the market expected return for the market portfolio. So I hope you understood the how to calculate the return using the capital asset pricing model. So if we will be given the risk-free rate, beta and market risk, certainly we will find the return on the stock. So here is the graphical representation of security market line or the capital asset pricing model. On vertical axis we have the required return, on horizontal axis we have the systematic risk or the market risk that is equal to 1. So if the stocks beta lies less than 1, it is average risky, it is not as much risky as the market. If it will be greater than 1, it will be the higher risky than the market. So it is the risk-free return, it is also known as the systematic risk, it is also known as the market risk, it is also known as the standalone risk. Then we have the risk premium, the risk that is above the market risk, it is the risk premium. So I hope you understood the idea behind the capital asset pricing model and the security market line. So if you will diversify portfolio, you will diversify your overall risk. So that was all about today's lecture. I hope you understood the idea behind the total risk, in which we discussed the systematic risk and the unsystematic risk, and we calculated the risk how that was the beta was the measure of risk. If it was 1, it was the market, it is equal to market risk. If it was less than 1, it was less than the market risk. If it was greater than 1, then it was aggressive. And we calculated the beta of portfolio using assigning the weightage average of beta by summing up all. And that was all about the today's lecture. See you in next lecture. Till now, Allah Hafiz. Like, subscribe, and press the bell icon button so that you can never miss any update from my channel.